We're really pleased to have Al Clark, a partner at Smith Adcock and Company. Al and I have known each other, I'm sure, north of 25 years. He had much darker hair and I had much more hair. We have crossed paths at a number of different construction associations where Al's been an active member and board member, including ABC, AGC, and CFMA. This topic's kind of been, as CFOs and controllers, you know, this topic's sort of been brewing out there for several years. It finally looks like some of this stuff, you know, coming right at us. And so discussing the different reporting changes that are imminent is very topical and certainly going to rock your world a little bit, I think, in the next many months. So Al is actually going to basically do an excerpt of a longer form program, which he has graciously provided to you in the binders that should be at your space. If you don't have one, let us know. We have extras. So please join me in welcoming Al Clark.
Doug, I appreciate it. And I appreciate the opportunity to be here. And with this organization of Sterling and with you folks, I'm honored. And it's a privilege. Thank you. Last time I was here was December 17th, 2017. It was 2 days after Congress had passed the new tax law. And I did an update on the new tax law. It was actually 5 days before the president signed it. That was fun. I went back a few days ago to see what I said. Was it actually true? Some of it was. That is a work in progress, but we'd been watching that through for several months anyway, so we had an idea of what was happening there. I appreciate the opportunity to be here. This is kind of a short excerpt. The course that you have, you can shut your book. We're not going to be following the course. That's so that you can take it back. And when you're bored this Friday night and have nothing to do, when Sunday afternoon there's not a good football game on, you can pull this thing out and read the course and focus on Chapter 2 and Chapter 4. Chapter 2 is basic GAAP principles. Chapter 4 is disclosures. Those are some of the main changes that we have seen from what the rules were before. In this, look for the underlined sections. I will have underlined things like ASC 605, which is the former rules. I will have underlined things like ASC 606, which are the current rules. So focus on prior rules, new rules, and I think that will give you a better understanding. This course was about 200 pages before I spent 200 hours and went through a printed stack of about 14 inches thick of other people's opinions and other people's writings and the actual 606 compared to 605 and things like that on the updates. But that was a lot of fun. I enjoy doing that. I hope it doesn't change for a while. I'm through with it for a while. But what we have right now may actually change before too long. In the end of your book is an example financial statement. I've tried to make some changes in there that would change things from the prior rules to the current rules just on revenue recognition. You'll see some changes in terminology. You'll see some changes in disclosures. And some of these things will change as the practice solidifies, and folks like me and others who work with this all the time will say, okay, we need to do it this way rather than that way. Public companies have had to comply with these new rules for a while now. It's not new for them, but for most of us with non-public private companies, this is new. And it hits for 2019. The board's meeting at 9 o'clock. You bring the smoke and I'll bring the mirrors. I'm sorry to say that in the construction industry, that's actually possible because a lot of what the bottom line and the balance sheet equity is based on is estimates. and estimates are subject to a little bit of manipulation. So watch out for situations like this. That was the case before. That is the case now. And with something that we will talk about briefly called variable consideration, it's not only estimates, but it's constraints that we then put on estimates. So the financial statements of contractors are just full of estimates, which allow for noodling of the numbers. But I'm not suggesting that you noodle the numbers. I'm suggesting that some people might do so inadvertently. Financial statement problems. If the financial statements have too much unexplained job fade, that's a problem. If there are no job schedules, that's a problem if it's going to the surety, but if it's going to the bank or somebody else, that might not be a problem. But for what you use, if it has no job schedules, that's a problem. No over or under billings on the financials. Now, that could be actually the case where there were no jobs in progress or whether everything was time and materials. And there were actually no over under billings. But in a typical situation, if you see no over under billings on a financial statement, that could be a problem. If the contractor used an accrual basis instead of percentage of completion basis, that could be okay, but it could be a problem. Job costs shown as inventory, problem. Unexplained bank overdraft, problem. Not using current GAAP per Accounting Standards Codification 606, that can be a problem. Is it GAAP? Well, it has to be in accordance with the rules in order to be a GAAP financial statement. GAAP is generally accepted accounting principles. So if you're not using current GAAP per ASC 606, that can be a problem. Contractor GAAP started out in 1955. Then we had SOP, Statement of Position 81-1, which came from the American Institute of CPAs, who no longer has anything to do with making the rules for financial statements. Then in 2009, for contractors, we had Accounting Standards Codification 605. 606 came in 2014 with delay until now. International accounting standards, never. You will not have to comply with international standards, in my opinion. Now, maybe 50 years from now, I don't know. But during my lifetime, I don't think you will ever see. But there has been some convergence. There will be a little bit of convergence here and there along the way. But the plan was years ago for international and American standards to be the same. That has gone way off track. We dodged that bullet. ASUs, Accounting Standards Updates, those are frequently, and ASUs issued since 2009 have been total 174. And yes, I updated some of these slides last night. I checked to see if there were anything issued in October, and no, there's still no additional. But this is a lot of changes in those few years since we have had these accounting standards codification. We've had a lot of updates. One of the updates that's not in your sample financial statements in the back has to do with presentation and on the balance sheet and the income statement for marketable securities, debt and equity securities. But you should see that coming soon with some of the financials. Why do contractors with long-term contracts need their own GAAP? Well, because they have long-term contracts. How do you account for each year the income, the expense of a 5-year contract on an annual basis? What's wrong with billings? We bill, we recognize that as revenue. What's wrong with billings? By definition, billings do not represent revenue. Billings represent an agreement between the contractor and the owner as to how cash flow is going to be handled. Doesn't have anything to do with revenue recognition. And of course, if we were having a bad year and we could use billings, we just bill very heavily right at the end of the year, and all of a sudden our bad year turns out to be a good year. That can be a problem. So billings are not revenue. All right, we're going to start off with a test here. Here are our facts. Contract amount, $876,000. We have billed $478,000. Costs incurred are $521,000. Our total estimated costs are $793,000. This is your test. You don't have any calculators, but are we overbilled or underbilled, and how much?
Overbilled. receive approximately 83%, not underbilled.
Yes.
Yeah, you are.
It's underbilled by 97,623.
Okay.
Right, man?
Underbilled by 97,623. What's your name?
Right woman.
Julie?
Rain Man.
Good job. Have you got a calculator?
Yes.
Okay. Actually, thank you, Julie, for helping me with that. She had the answer ahead of time. So the cost of $521,000, total estimated cost of $793,000. Numerator, denominator, we find out we're 65% complete. So 65% of the contract amount is $576. We compare that with the amount billed, and we see that we are underbilled by $97,623. And that was the same process you went through, was it?
Yes.
Good deal. Thank you. Got to have a little fun every once in a while. Can't go to sleep yet. Is accrual okay for long-term contracts? Sometimes. It depends on the contract. There are some pros and cons. OCBOA, other comprehensive basis of accounting. Is that ever okay for GAAP for long-term contracts? No. Tax method, cash method, the AICPA financial reporting framework is not GAAP. Now, some people, a vendor or somebody like that may say, okay, just give me a tax basis financial statement. That's okay. We'll use it, but it is not GAAP. Completed contract method is the old terminology. Point in time recognition of revenue is the new terminology. That may be okay in some circumstances, but under the new rules, the rules have changed. You cannot use a completed contract method anymore in your financial statements. Now, that's not true for the tax return. We still have the completed contract method for the tax return. But for financial statements, percentage of completion can be computed with many variations under the old rules and the new rules. You can calculate percentage of completion, the numerator, the total costs incurred, denominator, total estimated costs for all contract costs, or you can define the contract costs that you want to use, labor costs, labor hours, machine costs. You can use engineers' estimates or architects' estimates or the project management's estimates, which can be a little iffy, maybe very optimistic, but according to the rules, yes, you can. Now, I would say don't prepare your financial statements based on the project management's estimates of progress towards complete satisfaction of the performance obligation, but use that as a double check. Use that as a double check. Or any other estimates. The operating cycle, what is it and why is it important? In a typical industry, the operating cycle is the time that you take cash, buy materials, goes into inventory, you manufacture the inventory, you sell it, goes into receivables, and then back into cash. So from cash to cash is the operating cycle definition. In the construction industry, we can define the operating cycle. We define it very similarly, but it's not cash to cash because that could be a 30 or 60-day period of time. We define the operating cycle in the construction industry as the length of time that it takes from the start of the contract to the end of the contract. So from the beginning cash to the end of the cash can be your operating cycle. And that's important because the way you define the operating cycle determines what is a current asset and what is a current liability. For example, retainage receivable. If you have a 5-year contract, that retainage could be out there for 5 years or 6. Hopefully not longer than 5 years and a month, but it can be out there for a long time. Is it going to be received in 30 days, in 60 days? Probably not. But in your definition of the operating cycle, that will be a current asset, even though it won't be received for perhaps a long time. So you define the operating cycle. That defines what is included in current assets and current liabilities. So current assets can include retainage receivable, materials, equipment and tools that are bought and used specifically for a particular job. not your general fixed assets, not where you buy a bulldozer that you will be using for the next 10 years on many jobs. That is still property and equipment. But if you are buying something for a particular job and it's going to be used up, consumed, or disposed of at the end of that job, believe it or not, that's a current asset if it's not a job cost. And if it's a current asset, then it's going to be amortized to the job over the period of the life of the job that it is used. Underbillings, that's a current asset. It's got a new name going forward, but underbillings. Receivables, current estimates, claims. Claims hopefully are a current asset, but sometimes claims stretch out. Since a claim is job related, by definition of the operating cycle, it is still a current asset under the old rules and the new rules. But if we get past the end of the job and you see that the claim is going to be in litigation for several years, then that claim receivable probably needs to be moved down to non-current. But the general rule is anything that is related to a contract is a current asset. Unbilled receivables, deferred pre-contract costs, joint venture assets, if we're using the consolidated method or the expanded equity method, those current assets of the joint venture will be current on your financial statements also. Contract-related current liabilities, accounts, and vendors payable, of course. Subcontractor and subcontractor retainage payable, of course, will be current. Overbillings. Now, overbilling sometimes will always be on your financial statements. You may look at overbillings as being always there. It's always going to be there. It keeps rolling forward. And in many cases, the billings and the contracts are structured so that you will have overbillings all the time. You do not want to be operating off of your money. You would rather be operating off of the customer's money, and that's where overbillings come into play. This changes just a little bit with the new rules, which we will talk about shortly. But even though you always have overbillings on your financial statements, that does not make it a non-current liability. It's still a current liability. Deferred income taxes under the prior financials could be current, could be non-current. Uncertain tax position accruals. Has anybody in their financial statement, don't raise your hand, but just think about this, ever had an accrual for an uncertain tax position? Probably not. That doesn't mean that you've computed something wrong for the tax return. It means that something is uncertain. And when you have an uncertainty, for GAAP purposes, you are supposed to make an accrual. Then for tax purposes, if you have an audited financial statement, and if you have disclosed on there or accrued an uncertain tax position, you're supposed to file a separate form for that uncertain tax position with your tax return. But under prior rules, the uncertain tax position accruals could be current or non-current. That has changed. Accrued contract costs will be current. Advance payments on contracts, wouldn't that be nice if all of our customers always gave us advance payments on contracts? We see that every once in a while, but advance payments are a current liability. Debt on contract equipment. I mentioned this equipment that you buy for a particular contract that's going to be used, consumed, or sold at the end of the contract. If you have debt on that special equipment, that debt is current, even though the debt may be structured as a note payable for more than 1 year. Contract losses. We don't see contract losses now, right? No contract losses anymore. Times are good, but still we're going to have some hiccups. There will be a contract loss. And according to the old laws and the new laws, we still have to recognize that contract loss immediately, and it is going to be a current asset, even though, let's say this is a 10-year contract, and we're really not going to actually, according to our feel, according to cash flow, according to final closeout, see this loss until 10 years from now when the job is over. But if we have a loss, we have to accrue that immediately, and that will be a current liability on your financial statement. Joint venture current liability. Some new terminology. Contract assets and contract liabilities is new terminology for the balance sheet. We have not had this before. This is one way that a financial statement user can recognize, are the 2019 financial statements actually in accordance with GAAP or are they not? If the new terminology is used, and these are the first two new terminologies that we'll be talking about. Contract assets, that is a conditional right to consideration. Think about underbillings. That's a contract asset. In the note disclosures, we will still have a calculation of underbillings and overbillings. On the balance sheet, that and other contract assets will be in a line item called contract assets. And as an asset, it is subject to assessment for impairment. Now, we probably will not have an impairment assessment on most contract assets. Now, when I talk about an impairment assessment, think about on your balance sheet, you may have some land. And that land, you may have bought it for $500,000 and now it's worth $400,000. You need to assess impairment and write that down to $400,000. That's an assessment for impairment. So as a contract asset, all of these contract assets are subject to assessment for impairment. Now, one of the things that's different about international and U.S. GAAP is, in that particular case, if you assessed this $500,000 purchase price land down to $400,000, then in a subsequent year, if it went back up in value to $600,000, according to international standards, you'd write that back up to $600,000. According to U.S. generally accepted accounting principles, it would remain at $400,000. If you write it down, that's what you have to do. If it has been impaired, but you cannot then write it back up. So that's one of the big differences between international and U.S. Contract liabilities, it's a conditional obligation to perform. The customer has performed, the customer has paid, or the customer has been billed for this. It's an overbilling. It could be an advance payment. It could be loss provisions, but that is, you as the contractor, you have an obligation to perform as evidenced by the contract liabilities. So you either have to perform or possibly pay that back, but that is a liability. And a lot of these types of contract-related conditional obligation to perform will be grouped into this category called contract liabilities. Now, for 2019, you will still see on some financial statements overbilling and underbillings on the balance sheet. That is not wrong. That is allowed. But let me suggest to you that if you are taking the step to be fully compliant with the new GAAP rules, use the new terminology that in the future everybody will be using. If a financial statement has overbillings and underbillings on the balance sheet, my question would be, okay, they didn't change that. That's an option. But did they not change it because nothing else is in compliance with GAAP, or are they taking this option to not change because they have the option for doing that right now? So let me suggest to you, use the new terminology. And those of you who use financial statements, watch for the new terminology. But the prior is not prohibited. My guess is in the next several years, customs and practice will dictate that over or under billings on the balance sheet will disappear. And everybody will soon call it contract assets and contract liabilities. And then in the disclosures, the makeup of the contract assets and contract liabilities will be disclosed. It will be contract assets consist of underbillings, advance payments, this, that, the other. That will be a disclosure in the notes to the financial statements. And the over or under billings calculation in the notes that you now have will still be in the new financial statements. Just will be called a different name going forward. Offsetting on the balance sheet. Offsetting is allowed for some things. Let's talk just briefly about offsetting. For example, if you have bank accounts, a payroll account, an operating account, a sweep account, a money market account, the bank is going to have a right of offset. On your financial statements, if you have money in your money market account because it's swept, but your operating account is negative, you can group those together. You can offset it on the balance sheet. You can show cash, even though some of your accounts are negative. But if you have an account with another bank, an account with Bank B, and Bank A has an overdraft, that's a liability on your financial statement because there is no right of offset with the bank. But when you have the right of offset, you can group them together. So that's an example of something that is offsetting is allowed on the financial statement. Offsetting is not allowed for joint checks. You get a joint check, you record it as income, you sign it over, you send it to the subcontractor for the reason of the joint check. You've got an expense, you've got income. They are not offset on the P&L. Receivables from owners and payables to subcontractors. Boy, if we could offset those, your income statement would start with gross profit. So another example of what might appear to be something that could be offsettable because it comes through in that manner. State tax asset, federal tax liability, or vice versa. Federal tax assets, state tax liability are not offsetable. The state can pull in your federal tax refund, but the general rule is they are not offsettable. Over or under billings are not offsettable. You compute it on a job-by-job basis, and then your total overbillings, your total underbillings make it to the balance sheet previously. Now they make it to the contract assets and the contract liabilities terminology on the balance sheet. And where I'm headed with this is we could not offset overbillings, underbillings before to one net over or underbillings on the balance sheet. Going forward, we cannot offset contract assets with contract liabilities for a net of the two of one figure on the balance sheet. That's not offsettable. Early stage gross profit deferral. In the past, some people have said, as a matter of policy, and perhaps on a job-by-job basis, that as a policy, we will not recognize gross profit on a job until it gets 5% complete or 10% complete or some point in time. This was allowed, and when we look back at history, we can see that in, back when Doug and I first started, estimates were done on paper with a pencil, not ink, but with pencil. And then we moved to spreadsheets, and then we moved to higher, better ways to do things computerized. But back then, when you were doing those estimates, I remember one of my contractors said, "How'd you get this estimate?" "Well, I went out there and looked at it. I saw a big depression over here, and I saw a mound of dirt over here, and I figured we'd bulldoze this dirt over here, and we'd take it over here, and there might be 1,000 truckloads of dirt, and that's the way we did our estimate." Okay, that was good enough then. That's probably not good enough now, but a conservative approach at that point in time would be, we really don't know what we have. We don't know if we're going to have rock or not. So we will take a conservative approach. We will not recognize any gross profit on this job until it reaches some point in progress, 5%, 10%, 20%. That was on a contract by contract basis, and typically on a contractor by contractor basis. It was a policy. The cons is it's very arbitrated. It can distort the contract reporting. You can be subject to claims of earnings management. Well, we estimated good this year because we weren't having such a good year, and this really helps. Arguably, it is not current GAAP. We cannot do that now. That's gone. Let me give you an example. Let's say we have a 3-year contract. It's going to be $100,000 when everything is said and done. Our costs are going to be $60,000, so our gross profit is going to be $40,000 at the end of the job. In the first year, we incurred costs of $14,400, which is 24% of the $60,000 total costs. So that's 24% complete. And this contractor says, we will not recognize gross profit until we are 25% complete. So in year one, they did 24% of the job. They actually had gross profit of $9,600, but they chose this option under prior rules of not recognizing gross profit until the contract was 25% complete. So in year one, they recognized zero gross profit. In year two, we actually did another $1,200 worth of costs. We went from $14,400 in total cost to $15,600 in total cost, which made us 26% complete, recognized $26,000 in revenue, $10,400 in gross profit in year 2. We did $1,200 worth of work. We're recognizing $10,400 in gross profit. Is that a problem? I would say so. Could you be accused of trying to manipulate earnings? Possibly so. In that particular year, we just chose 25% as our starting point. Next year it might be 20. The next year it might be 30. So in the third year, then we finish the job. We recognize all of our $40,000. But you see that in year 1 and in year 3, we did all of the job except for $26,000 worth of revenue, and we recognized no gross profit in year 1. Can we do that going forward? No. There was also an a thing under prior gap that you could elect to call a contract complete before it was actually complete. Now, the theory behind this was maybe it's 99.999% complete. Okay, just accrue the additional revenue, accrue the additional costs, call it complete, take it off your schedule of work in progress, finish it, throw it in warranty costs or other costs or small jobs next year, and it simplifies things. GAAP allowed that, but GAAP gave no guidelines on what early completion meant. 99.999%, that's probably not too much of a problem. Okay, let's call it 95%. Let's call it 90%. When a job is not, this is the way I play golf. Now, most golfers on a par 4 might get up to, they're 3 and they're a yard away from the hole. They say, that's a gimme, put down 4, pick up the ball, walk away. I do that at the tee. I par every round. At the tee, pick up the ball. That's a gimme. I'm going to make this in 4. Go to the next tee. An extreme example to illustrate a point. The cons, earnings management, you really have a credibility gap with the surety, because if that contract is not on the schedule of contracts in progress, they're looking for it. It could be a bonded job. You've called it complete at 96%. You've taken it off. You've accrued the additional amount. But the financial statement user is looking for that contract. Where is it? You've created a credibility gap, GAAP, even though you were in complete accordance with GAAP. This is not allowed under the new rules. Here's an extreme example to illustrate how these two things can work together. We have a $100,000 contract, 3 years, and we are electing an early stage deferral of under 30%. So in the first year, we're 29% complete. We are not going to recognize revenue until we're 30% complete. So in the first year, we recognize 0 gross profit on this job. We have an early completion election. Now, this is an extreme example to illustrate a point. An early completion election as a company accounting policy to call a job complete at 90%. So in year 2, we hit 90%. We pick up the whole gross profit in year 2. And then in year 3, we pick up no gross profit because we've recognized it all in year 2 when we hit that 90%. This is an extreme example to illustrate the point. We could do that before. That was GAAP before. Maybe not to this extreme extent, but it was still GAAP. It is not going forward. You can't do this. Neither is currently allowed under Accounting Standards Codification 606. It used to be. Now, 605 was just the former rules put into the codification with some ASUs along the way. 606 is an addition to the Accounting Standards Codification for the revenue recognition, which we are here basically to talk about the new rules. Now, why did it get so complicated for us? FASB said they wanted every industry to have the same rules for recognition of revenue when you have contracts with customers. So whether you're Verizon selling a phone and a 2-year plan, or whether you are a contractor building a building, or whether you are a contractor doing a 1-day service job, that's a contract with a customer. It's not the retail store that's selling a loaf of bread. That's not a contract with a customer, but think about the different contracts that you have that are affected by this. Some of the bigger companies made the switch to these rules with early adoption using a full retrospective transition, which most of you will not do, but what it allowed them to do was recognize revenue twice. That's pretty cool. They went back and adjusted the prior years with these rules. Then in 2018 or 17 or whenever they adopted, they recognized that revenue again, and that gave a nice bump to not total retained earnings, but to earnings for the year for some of the early adopters that were public companies. My recommendation to everybody here is probably not what's called a full retrospective transition, but a modified transition. We'll talk about that in a little bit. And you've got a lot of material in your book, which you'll be reading Friday night because we're accountants and we don't have a real Friday night life, right? Okay. Neither is currently allowed under ASC, Accounting Standards Codification 606. Contract costs, of course, are direct costs like materials, labor, and subcontracts. Our costs. Then we have our indirect costs, indirect labor, supervision, supplies, tools, insurance, repairs and maintenance, et cetera, et cetera, et cetera. Anything that can be allocated to a job because it was incurred because we have that job or other jobs is not a general and administrative expense. It's either a direct contract cost or an indirect contract cost. You can allocate that cost in any number of different methods. You can use as a methodology for allocating those costs, either contract revenue or direct materials or any basis of allocation that works for you, the type of work that you do, or that particular contract. If you have different types of contracts, you can allocate indirect costs to those different contracts based on the contract itself and not as an accounting policy. But most of us do the same type of contract over and over again. So it would probably be an accounting policy that here is the costs that we allocate, and here is how we allocate those costs to a job. Doesn't matter how we allocate costs to a job. It can matter. You can do it on any reasonable basis, consistently applied. Different allocations for different types of contracts. Does it matter? Let's look at an example. Two companies here, ABC Company and DEF Company, both have a $100,000 contract. Both have direct costs estimated at $75,000. Then we get to a difference. ABC Company says they are going to allocate $20,000 of their otherwise possibly G&A costs to the contracts. DEF Company says we will allocate $5,000 of our otherwise G&A costs. So of the total costs that we're looking at of $20,000 and $4,000, $24,000, or $5,000 and $19,000, $24,000, DEF Company is allocating $5,000 to the job. ABC Company is allocating $20,000 to the job. For that particular job, the net income is still $1,000. Let's say this is your total P&L right here. This is your total P&L. Bottom line still $1,000. Does it matter if you are ABC Company or DEF Company, assuming that we are doing this on a reasonable allocation on a consistent basis? Does it matter? It can matter. What if our $75,000 in direct costs, we have some slippage, we have some fade, and that goes to $85,000 because of price increases or bad estimates or whatever. Now we have a $9,000 loss at the end of the day. Now at the gross profit level, ABC Company has a negative $5,000 loss. Does this matter? Yes, because ABC Company has to immediately accrue that $5,000 loss. DEF Company does not have a loss. They are showing $10,000 gross profit, so there's no accrual of a loss. They're happy. They're good with this. Yes, there was some slippage. Yes, they're going to have a loss at the end of the day, but they don't have to accrue this because the loss is recognized at the gross profit level. So does it make a difference? Yes, it does. So now you're all going to say, well, let's be DEF Company and just lightly allocate to contracts. That might be a good result of what we're talking about here. But at the same time, you need to look at, in your situation, what costs would we not incur if we didn't have these contracts? And then you say, well, we're a contractor. We wouldn't incur any costs. Even G&A would not be incurred if we didn't have any contracts. That's not really the case either. But we won't get into the contract costing here any more than this today. But just to say that whatever your methodology is and however you did it under the old rules, you probably should continue with the new rules in your contract costing. But it might be time to revisit that also. 5 steps to revenue recognition. Anybody that has heard about the revenue recognition laws, or RevRec, the ASC 606, has probably heard of the 5 steps. We will look briefly at the 5 steps. Identify the contract with the customer. Generally, not a problem. We've got this document. We're the contractor. We've signed this document with the customer that says this is $1 million contract to build such and such. We've identified the contract with the customer. Sometimes it is difficult to identify a contract with the customer in some industries. So this is the first step for everybody. Identify the performance obligations in the contract. That's a new thing. Performance obligation. Under the new rules, one contract can possibly have 2 or more performance obligations. New concept, new terminology, new accounting for contracts. If any of you want these slides and don't want to be taking notes, I'll be happy to give you these slides. But this is all in the book too that you'll be reading Friday night up until about 3 o'clock in the morning too. I'll be happy to send these slides to you. Identify the performance obligations in a contract. Does it have more than one performance obligation? If it does, you are supposed to split that and account for that as 2 or more performance obligations. Let me give you a quick example. You've got a contract to build a high school. And as part of that contract, you're going to build the football facilities in the football field. Is that 1 performance obligation or 2? Probably 1, but you need to look at it and apply judgments to your decision. And why did you make the decision that that is 1 contract and not 2? That has to be documented. If your financial statements are audit or a review, they're going to be asking for that documentation. Why do you call this contract 1 instead of 2 performance obligations? Even if it's a compilation, compilations are supposed to be in accordance with GAAP, which means there will be some inquiries. How did you do this? It might not require the documentation, but there will be the inquiries, and it's still supposed to be in accordance with GAAP. Now, when can you have separate performance obligations? Let me give you another example. This is a page I ripped out of ENR magazine, which is August of 2019. The New York Power Authority is spending $1.1 billion to extend such and such and such and such, including the 15-year project is expected to begin later this year and will proceed in 4 phases. 15-year project, 4 phases. Should that be considered for possible multiple performance obligations in that particular contract? Absolutely. Will they come to the conclusion that there are multiple performance obligations? Perhaps so, perhaps not. And there might, even though it's 4 phases, there might be more than 4 performance obligations under the new rules, which means that this contract would not be accounted for as 1 contract. It would be accounted for as 4 or more contracts. So when the financial statement user, when Doug gets your financial statements, when Mike gets your financial statements and they're looking for 1 big contract and they see 4 small contracts on there, that's going to generate some conversation. Number 3, determine the transaction price to each performance obligation. And even if there's just 1 performance obligation for the 1 contract, it might be a little difficult to determine the transaction price because there can be modifications, there can be additions, extras, LDs, change orders. So the transaction price, this $1 million contract that has been $1 million on the financial statement under prior rules, the new financial statements, it may show 1.1 million because there's some bonus. There are some additions that we expect to get. Or it might be a $900,000 contract because we really don't think we can do this within the time period, and it's got $100,000 liquidated damages for not completing on time. So it may not show $1 million on the job schedule. It may show 900,000. It may show 1.1 million. Is that going to generate some conversation? Absolutely.
So we do see early completion bonuses, particularly on like road contracts.
Yes.
So are there governing rules around when you would be, would you have to like wait a period of time before you think that you might hit that before you would recognize it, or? You know,
Under prior rules, we would probably wait a period of time until we knew that we had it in our pocket or that we knew that it was coming. We were ahead of schedule, perhaps. We were so far ahead of schedule, there's no way we could blow it. And so we would pick up that additional bonus for early completion. But still, at the same time, under prior rules, most of us did not, because when you picked up that early bonus for your financial statements, you had to pick it up for the tax return.
exactly.
So oftentimes, even though we saw it coming, we still deferred unless you needed that in the financial statements. And then you went ahead and paid taxes on it. And so you paid taxes on something that you didn't have, but you thought you were going to get it because it was part of the contract amount. So there are some pros and cons here on both of these.
You're still going to be, even under the new rules, you're still going to be pushing back on that. That's a subjective thing. If you maintain that you don't think it's in the bank yet, you're not going to want to recognize it.
Good question. And this is part of what we're going to be covering, but let me go ahead. Because with this modification, this $100,000 bonus for early completion is called variable consideration. Variable consideration is something that can change. Sort of like variable excuses during tax season when I come in later and later at home. Well, the traffic was bad. Well, I had to get a tax return out. Well, we had to get this financial statement out. That's variable excuses. But variable consideration is something that is not fixed. It's going to change. It might be $100,000. It might be $50,000. There's a couple different ways of recognizing the variable consideration. But along with the new terminology of variable consideration, there's another new term called constraint. And that means instead of picking up this whole $100,000 of bonus, and we are not completed with the job, we don't have it in our pocket yet, we will constrain this $100,000. So the $1 million contract with the $100,000 of early completion bonus may be $1 million. It may be 1.1. It may be $1,050,000. It may be $1,010,000 after we apply the constraint concept and calculation to the $100,000 possible bonus. A lot of judgments that go into this, and one of the disclosures that you will be required to make going forward is a disclosure of your judgments on estimates that are used in the financial statements. Number 4, allocate the transaction price to the different performance obligations, and then compute revenue as the performance obligations are satisfied. The old terminology was we are moving towards completion of the job. The new terminology is we are recognizing revenue as we move towards complete satisfaction of the performance obligation. Complete satisfaction of the performance obligation. So those are the 5 basic rules that apply to every company in the country that has contracts with customers, whether it's your cell phone, whether it's construction, whether it's whatever kind of contract it might be. It might be a 1-day contract. It might be a 5-day contract. It might be a 10-year contract. The same rules apply to every company. And that's what they were trying to do. And the construction industry really dodged the bullet. This started off as a very bad thing for the construction industry. FASB wanted to have performance obligations every step of the way. Your typical contract where you went in, you cleared the site, you did this, you did that, you put in the infrastructure, you put in the concrete, then you put in the steel, then you built it up, then you put on the roof, then you put in your HVAC. Starting off, every one of those line items on your bid was a separate performance obligation that you would recognize revenue as you did it. So when you're halfway through a job, the first parts of the job may have been 100% complete. The second line items may have been 40% complete. The rest of it may have been 0% complete. And the recognition of revenue was a mess. And the surety industry was one of the big ones that got in and said, this is going to cause so many problems for us. This is a train wreck. We will not be able to tell where a contract is. What's wrong with cost to cost like we have been doing it? And that's pretty much where it ended up. But we do have these separate performance obligations. And previously, we had rules that you could sever a contract into 2 or more contracts and report them as 2 or more contracts. That concept is in this current accounting standards codification, and it's called separate performance obligations. It's just treated a lot different with different rules, but the same concept is still there. So those are your 5 basics. Revenue is recognized when a good or service is transferred. The good or service, now good or service is the word that they use. When we talk about a good, that means construction, materials, and labor and everything. When we talk about service, we're talking about maybe a CM project or a consulting project or something like that these rules apply to. So good or service concept, that terminology is used in this codification. Good or service is transferred, and it's transferred when the customer gains control. It used to be that we focused on title. When did the customer get title to what you were doing on the job site? Now it's when did the customer get control? Probably the same basic thing with all of our contracts, because when you are working on the customer site and you put some materials and labor into that project, since the customer owns the real estate, they actually own what you have improved their real estate with. And they have control. Construction improves the land, so the customer has control immediately. Control's typically not that much of a problem for us. With some industries, it is. But we have to look at control. There might be a point in time when the customer doesn't have control. Perhaps you're doing prefabrication off the job site. The customer does not have control of that prefabrication until it hits the job site. So there can be some situations with your work where control, transfer of control can be an issue. Revenue is recognized at 2 different points in time, at a point in time or over time. In the construction industry, the default is over time. A 5-year contract, we're recognizing revenue at each point in time that we compute over under billings, and at each point in time that we do a GAAP financial statement. Monthly for your financial statement, you're recognizing this revenue over time. As compared to a point in time, you may have some of these too. If you have a service department and you do 1-day service, you bill it. That's revenue recognized at a point in time. You do 3-day service project and you bill it. That's revenue recognized at a point in time. If you have a 5-day service project and it spans the December 31st year end, that might need to be recognized over time rather than at a point in time. But consider materiality too. If it is immaterial, you can still recognize that at a point in time. Materiality enters into everything that we do on GAAP financial statements. And some of concepts like this, in that particular situation, you would want to look at materiality. Okay, we're not going to treat these 100 jobs that were 3 to 10-day jobs that were in progress at December 31st as overtime. That's just ridiculous. We can treat those as revenue recognized at a point in time, which is generally when it is billed. When you recognize it is determined at the contract inception, which is important. You may have a 6-month contract that starts in May. You complete it in December. You had originally called it revenue recognized over time. That's okay. It's not going to change unless something substantial changes with the contract or the performance of the contract. But the general rule is you determine when at contract inception whether you are recognizing revenue on this contract at a point in time or over time. Two new concepts with these new rules: point in time or over time. Control by the customer. What establishes that? When the customer receives and consumes. Are our customers really consuming? No, but they are receiving it and they have it. The entity enhances or creates a customer-controlled asset. You improve the property. Or an asset is created by you, the contractor, that has no alternative uses to you, the contractor. Even if you're prefabbing something as a sheet metal subcontractor, for example, do you have an alternative use for that? Probably not, because that's for specific design for that particular contract. You might be able to tear it down and use it or scrap metal it or something like that. But if you have no alternative use for the entity and you have an enforceable right of payment, which I hope you do, it's called a contract. You build it, they pay you, and hopefully you have an enforceable right of payment. With those particular situations, the customer has control, and that would be when you recognize revenue based on the customer having control under the new rules. The point in time for new accounting standards codification 606 is somewhat similar. It sounds similar to the completed contract method under prior 605. Now, 605 did not get completely superseded. We still have 605. It's just some parts of it are still there. So once all of this settles out and changes out, we still have to look and see what was left in 605. It's going to have some changes. The completed contract method considered risk. Point in time does not. An example that I like to give on this and would be, let's say your contract is to build a hotel on the top of Mount Everest. Is that pretty risky? Yeah. How many hikers are going to lose their life on that? Can we get the materials up there? Kind of a risky contract. Under the completed contract method, or under prior rules, we would account for that under the completed contract method. Our billings would be a liability. Our costs would be an asset. We would not recognize any revenue or costs on your P&L until that contract was done because of the risk of that particular contract. Under new ASC 606, risk is not a consideration. Under the new rules, you would recognize revenue equal to your costs if you had no idea what your bottom line profit was going to be on that. Big difference in recognizing revenue equal to costs. Or if you thought you were going to have a loss on it, who knows, building a hotel on the top of Mount Everest, whether we're going to have a loss. The tents that they sleep in, probably about as structurally that they're going to have on the top of it. But as an extreme example to illustrate a point, risk does not enter into point in time. Completed contract method consider the ability to estimate. Maybe the job is to implode a building and bring it down. The folks who imploded the cranes at the Hard Rock Hotel, which had a collapse, would you be able to estimate what your profit would be on the job of imploding those cranes at that bad construction site? That'd be tough. Under prior rules, you would consider the ability to estimate. And if the ability to estimate closely was not there, you could use a completed contract method. Point in time does not consider that. Here again, if you thought that you might have a profit, which you would constrain under the new rules, you would still recognize revenue equal to the costs that you have incurred and then constrain that back to something else, which in practical application would look a lot like the completed contract method, except that we would have some revenue on the P&L, we would have costs on the P&L. Under the completed contract method, you would not have revenue or costs on the P&L until the job was done. Big difference. It sounds very similar, but it's big difference. The transaction price appears to be simple. Yeah, we've got a standard AIA document. We've got a consensus doc. It says $1 million on it. So what's so complicated about the transaction price? A lot of things. We can have bonuses. We can have penalties, change orders, claims, shared savings, alternates, extras, additions, whatever else we might have. Rock clauses, add them up there. Those are variable consideration under the new GAAP terminology. So just figuring out the transaction price under the new rules can be a challenge when you take all of these things into consideration. Let's look at an example. The contract says $1 million. It has a $100,000 early completion bonus. Is this a $1 million contract with $100,000 of variable consideration? Yes. Let's look at it the other way. $1 million contract with a $100,000 late completion penalty. Is this actually a $900,000 contract with $100,000 of variable consideration? It's a big question. And when the financial statements with the job schedules goes to the surety and they see $900,000 on there instead of $1 million, they're bonding this job and they're saying, wait a minute, didn't we bond $1 million job? Why is this showing $900,000 on here? Well, we might, under the new rules, under the current rules, let me not say new rules, let me say current rules, we might actually have a $900,000 contract with $100,000 of variable consideration. The GAAP contract price may not be the stated number on the signed contract. You've got documents, you've got calculations, and we have judgments. We are required to implement what they call judgments. Does this allow for easily manipulated financial statements? Going forward, yes. Prior rules, yes. Nothing has really changed there. But let me suggest to you that if you manipulate this year because this year's looking a little bad, let's put some fluff in there. It's going to come back to haunt you next year. And we do not want to do that, even though the GAAP rules really can allow you to do that. It may look good for 1 year, but it'll haunt you for several years to come. Allocation of the contract price to each performance obligation. So we have a contract, we've determined that it has 2 performance obligations. So now we have to allocate the contract price to each of those performance obligations in our calculations for our GAAP financial statements. Any reasonable method can be used, such as what if each one was a separate performance obligation, what would the price be? If it was estimated separately, or how does the market judge the price of this? Or what if we can compute one and then we take whatever's left and that's what we use for obligation number 2? Any method is okay for this as long as it's reasonable. You've got some sound judgments. It makes sense. There's some judgments to do on this. And this is determined at the start of the contract. So you can't change this during the life of the contract unless something very significant changes in the contract. One contract, 2 performance obligations. They're priced separately. They're costed separately. There's different things going on here. So we're going to treat them as 2 separate performance obligations. You allocate the transaction price at the start of the contract, and that's what it is during the life of the contract. Think about this. If we could change that during the life of the contract, we could really noodle the numbers, couldn't we? And FASB does not want us to noodle the numbers. That's a highly technical term, noodle the numbers. You won't find it in FASB, but you'll find it lots of places. It's a good time for this. Business Week, several years ago, cover story, fuzzy numbers. They were saying that all financial statements should be on the cash basis because you can't argue with cash. Can you imagine Microsoft reporting its financial statements on the cash basis? Can you imagine us reporting our financial statements on the cash basis? You can't argue with cash, but I don't know what this particular writer was enjoying before he or she wrote this article, but it was an interesting article. And with GAAP like it is right now, as you can see, there is some ability to noodle the numbers, but don't. Understand that it can be done, but don't do it because it'll come back to haunt you in spades. The allocated price is determined at the beginning of the contract, and it stays that way through the life of the contract. You cannot change that during the life of the contract. What's a standalone selling price? Well, maybe you're a mechanical contractor and you've got this standalone selling price of such and such that is always the same price for doing this particular job with this particular piece of equipment. That could be a standalone selling price. Or if you're AT&T and you're selling a phone along with a service contract, the standalone selling price of the phone could be A, and then the service contract could be B, and you'd probably have two multiple performance obligations in that particular situation. Is warranty separate from the base contract? If it's an extended warranty, it might be separate from the base contract. If it is your typical warranty that you expect to go back into this building and tweak the HVAC system and change a couple light bulbs after you've left the job site, and maybe repaint or recarpet something in a typical warranty, that is not separate from the base contract price. But there are some extended warranty, extended operating provisions in some contracts. Build the project, warranty it for 5 years, operate it for 10 years. Those kind of things, it could be multiple performance obligations and probably would be. But typically your contract will have a minimal amount of warranty expense. And when we look at materiality with these rules, from our perspective, when we talk about materiality, we're talking about total financial statement materiality. With these rules and materiality on something like a separate performance obligation, you're looking at materiality from the contract level. So if you do $100 million a year, materiality may be $1 million for the overall financial statement. But if this is a $100,000 contract, your materiality may be $10,000. So it's a little bit of difference. But typically, the warranty would probably not be a separate performance obligation from the base contract. And keep this in mind, if the margins are the same for two performance obligations in one contract, whether you treat it as one contract or two contracts, it won't matter. You'll still be recognizing revenue at the same pace with two performance obligations that have exactly the same margins. But that still doesn't keep you from possibly being required to report it as two different performance obligations. Allocate the transaction price. Standalone selling price allocation methods, adjusted market assessment, estimated cost plus a margin, residual approach. Residual approach is, okay, we've got two performance obligations. We can nail down this one. We really don't know what the other one is. So we compute the one, and then whatever is left is our transaction price for performance obligation number two. So a lot of different ways of computing this, like a series of deliverables with a master contract. And a master contract is sort of a contract, but not really a contract. And we really don't have a construction contract until that purchase order for that particular task is issued. So a master contract, do we have a contract? Yes. Do we have a contract in terms of ASC 606? Perhaps not. We don't have a contract under a master service agreement until that purchase order, that task ticket or whatever is issued to go out and do such and such. Then you have a contract. Taxes in the transaction price, not really a big deal for us, but for some people it is, and that is sales taxes. So you have an item that costs $100, and by the time sales taxes, that's $108. Do you record as revenue the 108 or the 100? You've got a choice. It really doesn't hit us unless you have a service department and you bill separately for your parts with sales tax and everything else, your labor that is not sales tax. Then you have this issue. As an accounting policy, you can choose. Do you want to include sales tax in there or not? Let me suggest to you that you don't. Don't include it. It can have some tax ramifications, but it really doesn't matter for GAAP purposes. You're collecting it for the jurisdiction that you're going to be remitting it to. So that's probably more typical, but under the new rules, this is specifically mentioned that you do have this option. What time are we through? 9:15?
Said 9 on the invitation.
Said 9 on the invitation?
I was thinking I got 50 more slides.
Okay.
I mean, we can keep going, and if you have to step out, then.
Friday night, you won't be reading this. I'll still be here talking. This is a condensed set of slides from the course, which is highly condensed from the actual rules. Variable consideration, measured by probability of numerous outcomes. You may have some of these, or it could be a discrete binary, yes or no. Did we complete early? Yes, no. Did we get the bonus? Yes, no. Or what are our liquidated damages for completing late? That could be a probability. Are we going to have liquidated damages of 10,000, 50,000, 100,000? What's the probability of that? Then that would be how we compute the measurement of our variable consideration under different circumstances. And then you apply the constraints to that. And that can vary from contract to contract. This is not an accounting policy. This is a contract by contract. We have to constrain the estimate. And let me move down here to this part. Focus on the significant reversal. If you have an estimate, let's say our contract's $1 million and we know there's going to be rock and we have a maximum rock clause in there of $100,000. Do we have a $1.1 million contract from the start? No, we don't, because we don't know how much of this rock is going to be extracted and how much we are going to actually bill for and collect on the rock clause. But as we get into it, maybe we find some rock, so we constrain the estimate less. Going forward, and this is going to, we want to make sure that with constraining estimates, we do not have to come back later with what's called a significant reversal of the total contract price. So let's say we're 20% into this job and we've got a $100,000 rock clause. We're recognizing 20% of the contract. And let's say inadvertently or by mistake or because we want to noodle the numbers, we recognize the whole $100,000 in the rock clause. We're calling it a $1.1 million contract right from the start because of this rock clause. Are we going to have a significant reversal in the total contract amount by the time we get to the end? Probably not, even if we only have $50,000 that we bill on this rock clause, because that's in the total contract amount over the life of the contract. And if we've picked up too much early, we may not have a significant reversal by the time we get to the end of the contract. We're skipping ahead some. Financing component. Some contracts with customers will have a financing component. Think of a furniture store that says no payments for the next 5 years or no interest for the next 5 years on your purchase of over $500. They have a financing component in their contract with customers. We typically do not. Retainage is not a financing component. Even though the customer is retaining some of your money, you are not financing the job. That retainage has a commercial purpose. It is not other than financing. It is not a financing component. Underbillings are not a financing component. Payments on a milestone basis on a contract that pays on a milestone basis is not a financing component. You will probably not face this situation, but just be aware that it is there. You may have multiple performance obligations based on the construction you're doing and the financing component. Some of these big mega jobs may very likely have financing components. Public-private partnerships, for example, P3s, you may see those. Non-cash considerations. If the customer supplies the materials, is that a non-cash consideration? Is that revenue? Sometimes it is, sometimes it is not. But if it's a non-cash consideration, you're required to pick it up as part of the contract amount. Step 5, recognizing revenue. Input and output measures. Those rules are still basically the same. You can use an input measure or an output measure. whatever you use, you're required to be able to quantify and estimate what the total amount may be. This may or may not be an accounting policy. It may be a contract by contract thing. Let's skip a few slides. Basic percentage of completion calculation. We can use labor hours. You don't have to use costs, old rules, new rules. But let me suggest to you that you use cost to cost, because that's what everybody else in the world uses. There might be a contract where labor hours or machine hours or something else would be more appropriate for that contract. Let me suggest to you that if you do that, you disclose that, your judgments behind it, and why you pick this other method, which is allowable for that particular contract or contracts, other than noodling the numbers. Different input measures, different output measures. Here's an interesting thing, cost of contracts, other considerations. If you have budgeted wasted materials, if you have budgeted wasted labor, if you have budgeted rework, that's part of your contract amount. But if something happens, a hurricane that was not budgeted for hurricane costs, for example, that is not a contract cost. Strike costs, cost of design errors, some of those things. That's not a contract cost. Uninstalled materials. Any questions? I'll be through here just a little bit. Uninstalled materials. Just incurring a cost may not represent progress towards completion, or in the current terms, may not represent progress towards complete satisfaction of the performance obligation. Same thing, different terms. So you've incurred some costs, you've bought some materials. Uninstalled materials are generally, under the former rules, excluded from the calculation of percentage of completion. Under the new rules, it is different. Your uninstalled materials can be recognized as revenue, but no gross profit. And if those uninstalled materials are significant and incurred at the start of the project and are going to be utilized over the life of the contract, you will probably capitalize those on your balance sheet, amortize those to the job over the life of the contract. Other initial costs that would meet this definition under the new rules could be mobilization. The surety fee, for example, is actually applicable to the whole contract, but up until now, we would take those initial costs, and once we have the contract, we would charge them to the contract, we'd recognize gross profit, even though nothing had really been done with the concrete and steel. No production had been done, but we have costs and we recognize them. We pick up a little bit of gross profit, not a big deal. Not an overstatement of profit or anything, because it's probably immaterial in respect to the whole financial statements and the contract as a whole. Under the new rules, these initial non-production costs would be capitalized on the balance sheet. It would be a part of a contract asset classification, and it would be amortized to the contract over the life of the contract. A little bit different there. And you've got a lot of mobilization, upfront fees, things like that that would meet this category, which is a big change from prior year rules. I better stop. I've run out of time. 3 minutes ago. What questions do you have?
How can we get this presentation?
I'll email it to you. Or I'll give it to Katie and she can email it to everybody. And you get a warranty with this also. The warranty with this presentation is any questions that you have, just give me a call, shoot me an email. Glad to help you if I can.
What is your definition of modified restatement?
Of what?
Modified restatement of the funding.
Modified retrospective transition. You go back and you recompute the prior years. And on a multiple year presentation, those prior years are changed. Let's say you typically have 5 years that you show on your financial statements. Those prior 4 years would have changed amounts under a full retrospective transition. Under a modified retrospective transition, which a lot of non-public companies are doing, I would highly suggest it to you. You go back and you look at the contracts in progress at December 31, 2018. You see if any of these rules apply. Would anything have changed that is material? And if there is a change, then you would make a change to the retained earnings that are carried forward into this year, and then keep on trucking going forward. Bigger companies will probably have full retrospective transition, but some of them don't. Good question.
On the uninstalled materials, is that a materiality thing by contract? Or?
Question is on uninstalled materials, is that a materiality concept by contract? Under the old rules, probably no. Under the new rules, yes. Because it is a contract asset. So materiality would be assessed at the contract level, which is different from assessing materiality at the performance obligation level, just to make things complicated for that answer.
All right. Does it matter whether those materials are on-site or off-site? If they're still at the manufacturer, like bridge beams?
Under bridge beams, still at the manufacturer, uninstalled materials, has control transferred to you? No.
No.
It's probably not uninstalled materials. Has control transferred to the customer? No.
The customer's paid for as a material allowance, but the beams are still sitting, still haven't been approved, but still sitting at the manufacturer.
You may have a overbilling situation, a contract liability, to where the customer has performed, but you have not yet performed. So that would be an overbilling, which would be a contract liability in that particular case. Good question.
If you can recognize zero revenue on it, right? Got cash.
You can't recognize profit, is that right?
You would not be able to recognize profit under the old rules or the new rules. If control has transferred, which in this case, if control has not transferred.
Owner, we paid the vendor. Okay, the vendor's bill basically, they're allowed to bill like almost 90% of the cost up front. So when we actually ship the beams and install them, they bill the last 10%.
Okay.
So
Good question. Look at control. When did control transfer to you or the customer? In this particular case, I don't think control has transferred. So you would not be recognizing any gross profit on this, and you would probably not recognize revenue on this. Now, this is new for all of us. Yes, I spent over 200 hours updating this course this summer, and the stack of documents that I used was 14 inches thick, and that was just what I printed out. But it's still a work in progress. The example financial statements that you have in the back, there will very likely be changes over the next few years as this is solidified in practice. But this is where we are right now. Any other questions? Good questions. There's still food left. Yes, sir.
As far as working papers and all that, I imagine, CPA bills are going to go up. Getting this in practice, you get to document a lot more is kind of what.
We have some people who are attending this remotely, so let me repeat that question. Because of all the documentation and changes, CPA bills are going to go up. I'm glad you asked that question, Mike. That depends. How much of this you do? These are your financial statements. The CPA, you're really not theoretically looking to them to do all of this work. So the more that you do, the less that they have to do. Here's our judgments. Here's our calculations. Here, you audit it. But in practice, it's going to be more of we will be holding hands of a lot of people who really don't know what to do. Keep in mind materiality. Yes, we might have two performance obligations theoretically, but materiality, do we? and what were our judgments. And basically, how is the customer looking at this? Is the customer looking at this as one contract, one performance obligation, or one contract, multiple performance obligations? How does the customer look at it? In most cases, your customer is going to be looking at your contract as one performance obligation. That makes documentation a whole lot simpler. That makes the time a whole lot less, but the process still has to happen.
So it seems like a worksheet or something to document the thought process as you put these contracts when you're with. That way, when you guys go into audit, you have a
Yes.
documentation to go to show you how you arrive at some of this stuff.
Yes. Yes. A punch list. Do we have a contract? Yes. Do we have multiple performance obligations? No. Why are you saying no? Here's our methodology in coming to that conclusion. The customer is looking at it as one performance obligation. Done. But then we get to the modifications. What kind of extras do we have? What kind of additions do we have? What kind of rock clauses? What kind of LDs? And it gets a little more complicated there too. It's a great time to be a CPA.
What about in the case where there's one contract, but it covers renovations, work done in part for a landlord and 3 or 4 different offices that are going to be billed to the tenants separately from those? There's one contract. So that's 4 or 5 different performance obligations?
It could be. Is your contract for the tenant work with the tenant, or is the landlord going to be paying that? So you'll have significant direction from the tenant. You'll have tenant specifications, but your contract is with the landlord. That is a good example of something that you need to look at and consider and probably arrive to the conclusion that it's one performance obligation. All right. Thanks for Sterling. I appreciate being here. This was a lot of fun. Sorry I went over. Keep the warranty in mind. Any questions you have, give me a call, send me an email.
10-year warranty, is that right?
10-year warranty.
All right, thank you everyone for joining. Just a quick announcement, our next program will be a breakfast at our office on Wednesday, November 20th. The topic is understanding my company's FMCSA score and CSA score. We're going to cover topics related to companies that have DOT and FMCSA vehicles and also smaller vehicles, so not just fleets. Kevin Colton will be our presenter. He's with HB Next. And HB Next is a great resource and is a one-stop shop for customized solutions for safety, DOT, fleet, stormwater, training, and software. You may have already seen the invitation, but I'll continue seeing it, and we hope to see you there. Thank you.
Hope this was good.
Well, you've got so that's
6 was the start. That's right. I just find to use the same cover to go less. Yeah. It says, yeah, please.
yeah, it's a good marketing tool for but
Good to see you.
but yet they had to pay $145 or something for that.
I can walk up there. You'll need a key card to get in.
Oh.
Are you ready to go
It's
now?
rough, isn't it? Yeah, yeah. Come out of that with sharp as gold. Right?
We have a whole bowl of them.
Good job.
Well,
It depends. Yes.
there's never a simple.
Yeah.
Did you do well? Then if you did this and this.
Yeah, because it still fits. What'd you do last year? The accountant's going to make more money. I was thinking the accountants the ones making these rules for their buddies,
That's
to,
right.
to
That's right.
have something to do. Yeah.
I have a question, and it is not about the financial reporting.
Shit, he didn't put that out today.
I know. We had, is that in the morning?
Yeah, you've got to pour the concrete.
Yeah, that's
early.
fine.
Yeah. And it has to do with just cash we have on. We have some new for the size of our company, sitting in MMA, money market. We were wondering if we transferred that to draw higher interest into 1 year, 2 years. Is that working capital? I don't know working capital goes up in current.
It just changes line item in your
Okay.
That's the surety may value.
That's what
See,
I'm.
we.
Oh,
man.
Horny voided.
Yeah. So, they move things up and down above the line.
Right, that was our
So
question.
if you have a
So for
multi-year.
bonding purposes, would that affect us on bonding? That's what,
Depends on what you're getting into.
How long a CD you're buying.
yeah.
I mean, the problem with CDs is what they pay. They're paying anyway.
Well, I mean, the money.
Versus money market account, it's
Well, the, we
incremental.
were looking at the CD was
Occasionally,
two,
yes.
and the money market is 0.7. For that's the 5 year.
Oh, really?
That's the title of 5
I
years.
don't know that I'm
Yeah.
entitled to cash.
No,
You're not gonna do that.
no. We were thinking, if you last 1 year CD or something like that, then it would go to 1.5 or something.
Yeah.
Yeah,
I appreciate you.
the surety, so like, if you got inventory, which I know you do.
Right. Well,
But for example, so if you put inventory on your line, they're gonna write that out.
right.
They're gonna, so their formulas come into play.
We got any short materials here? We, not 2 weeks ago, purchased 29,000 worth of light fixtures and have it on here for a job that we're working on, but there's like a contractor has no place to store it. And the tenant is occupied space, so they can store it on the job site. So we actually have, we pay for the material in advance.
You have builder's risk on that?
Going forward.
Do you have builder's risk on the job?
No, the materials are in our
I
warehouse.
understand, but your builder's risk policy should address stored materials on site
I'm talking
to a
about
certain.
names.
Yeah, I know, I'm just using the other brain. I just wanna make sure you think about that too,
Okay.
because that's why, we're the worst case scenario guys, everybody,
Yes.
we see stuff.
Well, that's funny of them.
Yeah, so,
I know.
but,
It's the IRS is responsible. What's gonna happen?
Heavy provides.
If you claim this and I know what you're doing, I know what's
financial road, yeah.
Been on rectangle, brother.
Yeah.
More structured worksheet or something.
I don't know about, surety will, but again, that's not a big number, it's
No,
gonna
in
be a surety.
the grand scheme of things, it's not a big number on that. Well, we got into the store materials, I mean, literally, with the land, and we haven't done it in 3 years.
Right.
We actually purchased fixtures for a job that we're just starting, that we're having to store on our site, and we've already paid for it.
Right.
The
That's,
store material, and we just, I mean, literally, we just got started on the project. We only built for the full materials, but we can't recognize revenue. If we don't do anything between now and the end of December, we can't recognize revenue.
Did he know he
But
was
they're
doing
really
it?
interesting.
Yeah, give it to some
Okay.
APM.
John, good to see you.
You tried to do it.
Tell, Jake, you got Jake McCann back working over
Yeah,
there? You
yeah,
guys
Jake.
got the talent, I mean, they're all, yeah, tell him I said hello.
Okay,
Todd Bill, all
so-
those
Yeah,
guys.
I will.
Things are going
Things are going good for us.
Yeah, y'all
Yeah, it's-
are in Nashville too, right? A little, you got a lot of work.
Clear as
We got
mud.
tons of, I wish some there.
Thank you very much. Have a good day.
Downtown Nashville is 29 tower cranes.
Well, if you're gonna visit, job visit, you go up on Friday, right? So you spend the weekend. Have a good, I mean, it's a good town to go for the
Yeah,
weekend.
good enough. Anyway, yeah, thank you very much. Thank you, Mike.
Yep, good seeing you.
Thank you.
Yes.
When they do the 400.
They're ready for 400 or 285, one of those contracts.
Al, are you, any of your clients here?
And maintained for 30 years.
Julie Austin is taking a position with one of our clients.
Oh, good.
Uh,
Was she a friend of yours before, or?
She used to work for us.
Oh, really?
Yeah.
Okay.
Like the one they filled up 75.
And tax season burned her out.
You know,
And then
Well,
by the time,
You gotta get to-
close to recovering their.
you either
funds,
gotta
they're gonna
be built for it, or you gotta
maintenance,
Yeah.
deal with it for enough years where you can
And then the
And
rest
if the
of them
economy slows down, people
are
will stop
future
using it.
clients.
Right.
Because it's-
Hope
So
so.
this was a good group of folks here. Katie does a good job of getting the gang together.
I try. Well,